Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Most biases disappear once they work in our favor. We call it intuition when the math is uncomfortable. The smartest person in the room usually asks the shortest question. Hustle culture confuses exhaustion with achievement. Grinding is admirable until it replaces thinking.
Indian households hold about 34,600 tons of gold, now worth roughly $5.8 trillion, more than the entire market capitalization of Indian equities. That's not nostalgia, it's balance sheet logic. Urban India financialized through SIPs and equities. Rural India stuck with what's liquid, trusted and crisis-proof. Gold isn't just an investment here, it's collateral, insurance and savings rolled into one. The story of Indian markets isn't gold versus equities. It's when household gold slowly turns into productive capital. India has crossed 2 lakh startups, but geography still matters. Maharashtra, Karnataka, Delhi and UP dominate. Capital, talent and policy clusters at work. Beyond the top states, numbers thin out fast. This isn't a startup problem, it's a state capacity problem. Entrepreneurs go where codes work, power stays on, and paperwork moves. The next startup wave won't come from new slogans, it will come from states quietly fixing execution. Capital is shy. It goes where it's treated well. Everyone wants central banks to cut, but FX markets have other plans. Despite the sell dollar narrative, currencies like the Indian rupee, the Indonesian rupiah, and the Philippine peso are weakening and not strengthening. That makes easing risky. Indonesia can't just cut rates, it has to defend the rupiah first. The real switch flips only when the Fed cuts, and that's not happening just yet. In a high debt, high deficit world, capital is picky. Rate relief goes to countries offering growth, credibility, and currency stability. Diversification isn't rescuing everyone, differentiation is. India is caught in the crossfire of global trade tensions, so is doing the sensible thing. Diversifying partners one agreement at a time. Free trade agreements aren't magic bullets anymore, but they still lower friction at the margins. The key difference versus some peers. Lower policy risk. Central bank credibility holds, reforms crawl forward, not backward. It's not fast, it's not flashy, but it's predictable. In a volatile world, boring policy consistently and quietly becomes a competitive advantage. Speed is good, direction is better. India's tech exports are growing fast, even to the US, tariffs and all. That's the good news. The catch? Tech exports as a share of GDP are still the lowest in emerging market Asia. Meanwhile, energy exports like refined oil are rolling over, not just in India but globally. This is where divergence shows up. Growth helps only if it's big enough to matter. When you are overweight the fading sectors and underweight the future ones, cycles hurt more. Scale decides who feels the slowdown. Luxury brands are finally warming up to India, not because it's easy, but because China is not. A growing elite, rising aspirational spend, and global brand curiosity makes India attractive. But this is a long duration trade. High taxes, patchy logistics, and limited premium retail space keeps margins tight. India will not binge on luxury, it will age into it. For brands, this isn't about explosive growth, it's about planting flags early and waiting for compounding to do the work. Global electricity demand is forcing a rethink and quite fast. Power investments needs to nearly double to $10 trillion by 2030, and energy storage has to scale almost 20x to keep grids stable. This isn't green optimism, it's physics meeting data centers, EVs and AI load. Generation without storage just moves the bottleneck. The real constraint now is not demand, it's how quickly capital, permitting and supply chains can catch up.